All right, guys, welcome back to the Financial Beast podcast. I, of course, am your BFFF, best financial friend forever, Eric Miller. And the theme of this week seems to be, I'm talking to a lot of practice owners about exiting. And I couldn't think of a better person to bring on than Steve Stalzer of 8150 Advisors, who, and you're going to have to kind of like let me know. I don't know how many exits you guys have done, but I know it's a large number. But you are definitely, your firm is specializes in mergers and acquisitions and helping practice owners sell their practice. So I got a ton of questions for you, but thanks for coming on, man. I appreciate it.
You bet. Thanks for having me, and I'm glad you outlined what BFFF is. I've been meaning to ask you that, and I've been playing around with what I figured it was some version of that.
Were you confused? Yeah, I was like, one day I just, where that came from? Literally a client just came in and said, Eric, you're like my BFF. I'm like, really? They're like, yeah, but you're like my best financial friend forever. And I was like, oh, snap.
And it stuck. That's awesome.
I was like, man, that actually sounds pretty good. So
yeah, right. That's a great compliment.
I kind of ran with that. I probably should have named the channel that as opposed to Financial Beast, but what are we going to say? All right, man. Well, let's talk about, we'll start here. I think exiting, the funny thing is, I'll say this, when I first started working with healthcare owners for like the first 10 years, I maybe had 2 or 3 clients sell their practice. I mean, it was a very small amount.
Yep.
And then, something happened a couple years ago where there was just a waterfall of people that, now all of a sudden wanted to sell. And, I think there's probably a number of reasons for that, that we can kind of get into, but is that just me? Or is the amount of healthcare owners, I know you primarily work in the physical therapy space. Is that just, it's a phenomenon, right? I mean, it's happening. Have you seen that increase? I mean, I don't know how long you've had 8150 or, how many years you guys have been doing this, but have you guys seen a pickup of sales over the last, let's say, 5 to 7 years?
If you look back on it, I joined a private practice as a minority partner back in 2000. And I would say between 2000 and 2005, if we just kind of put it in 5-year chunks, there was a little bit of private equity investing in PT, but not a whole lot. You had some larger groups that had split up prior to that. And I think what you saw was pretty good success amongst private equity groups, in that, back in the early 2000s, that grew over time, probably by 2010, 2012, it was, relatively competitive space, several private equity groups, in the space. And as they did better, they're no different than you or I. We go to conferences, and talk about what industries, what's happening in different industries. And I think the more success there was within physical therapy by private equity groups, the more that drew interest in it. If you look back, 07, 08 during the financial crisis, in that time frame, a lot of PE groups and others, kind of looked at what was able to weather that storm, better than other industries, and PT, kept coming out on top, through that. And so I think if you look at the volume of private equity interest and how that's driven multiples, that has definitely grown, especially, 2010. You do see some small trends, and often you'll pick up an article and someone will say, hey, as the bubble burst, we saw less transactions in, 2000 than we did in 19. And it's generally a journalist just trying to sell an article, that makes a trend out of 1 year. So we've seen, several trends, growth between, 2010 through, 18, 19. Then you had not many deals being done, in 2020 because of COVID.
Right.
21, you had a lot of transactions because you kind of had this lost year.
Everybody was like, forget this. I'm not doing this anymore. Get me out.
That was a common call that we got in 21. The owners that sold in 19 called us and said, we're so grateful you got us, through that transaction, ahead of this. And then, that was a rough year. And so some that, had an exit on the horizon that might have accelerated it. So we do see trends, where you get, a couple years that are up or down, depending on interest rates, depending on supply and demand. It's no different than other industries. It's not immune to all those external factors. But yeah, it's more and more common that, as multiples have gone up, largely from competition going up amongst buyers, that it's just a more common strategy. The higher multiples are, the harder it is to do a quiet transaction to your next in line. We track the volume of transactions, but no one, captures all of them. And you have to kind of decide, are you capturing, the small ones or just, the external transactions. But yeah, I would say, since 2010, that trend has gone up. There's more buyers. There's always private equity groups trying to get into the space.
Yeah.
And yeah, it's we sold our practice 2015, at a time, a lot of people, then were saying, hey, multiples are, all-time highs. And, since that time, last few years, I've helped several owners sell, practices that were smaller than ours for multiples higher than ours. And obviously every deal is a little bit different. But yeah, I would say it's probably more transactions, historically, if you look back on the last 20 years. A lot more in the last 4 years than what we, had seen in probably any 4-year cycle before that.
And what is because you probably get a lot of people that come to call you, and there's probably, I know this is, my question is like, what are the main reasons why people are looking to exit out right now? I mean, obviously that's a question I'm sure you ask them when they first come to you, like, hey, why do you want to exit in the first place? They're like a top three that you usually hear.
Yeah, I would say most common and most straightforward is someone's nearing retirement. That might be in, 2 years, it might be in 5 years, but they're just getting to a stage where they say, hey, I'm not too far off from retirement and need to start working on my succession plan. The next, I would say, might be a smaller group, but a group we tend to work with a lot, where they've had a lot of success. They've grown the value of their business, and they might be talking to you saying, hey, I'm only 50. I'm not ready to hang this up, or, whatever their age is. But when I sit down and look at my personal assets, 90% of my personal assets are in this business. And while they've grown it and it's been very successful, they're just starting to get to a point where diversification, can make sense.
Mm-hmm.
That might also align with, they've got a lot of growth opportunity, but it makes sense to at least look at, do I diversify a little bit and be more aggressive with growth, but I'm being aggressive with a smaller percentage of my assets. And so it really is an asset allocation and just making sure the family's taken care of, but now I can, do some acquisitions. I can, do some things that are a little bit more aggressive that maybe I don't want to take all that risk on myself.
Yeah. So they're taking some chips off the table, so to speak. They've built this thing
100%.
to, 10, 15, $20 million. Let's take, 7 or 8 million or whatever it would be. And then, bring in someone that has a better skill set to take it to another level.
Exactly.
Above that. So yeah, I've seen that.
And then some variations of that, where owners have opportunity to grow, whether it's acquisitions, whether it's de novos, but just don't have the capital or the team. And rather than build out, their team, they say, hey, it's time to bring on a partner, so that we can, to some extent, grow smarter. Maybe it might be capital, it might be, support services, but different variations of that. But I would say those are the two most common. Is, one is nearing retirement, 2, taking some chips off the table, and and then 3, and sometimes those overlap, is the support services that a partner can bring. Owners will call and say, hey, it's harder every year to negotiate rates, and being part of a bigger network, where I've got a team that negotiates rates, I got a team that negotiates leases. I'm wearing 12 hats, and I'm not a specialist in any of them. And what I really want to do is focus on, get back to, take care of the team, focus on the operations, and not, do 12 different jobs, in any given day.
Yeah. So, and I guess that would equate to burnout to some degree. People just get burnt out and they're just like, I don't want to do this anymore.
Burnout, I would classify as a fourth call. And, and those are probably the hardest ones. I shouldn't leave that out. But we will get calls from an owner who just says, hey, I'm burnt out, the practice isn't running great, I'm fatigued. Those are tough because, as there's not a lot of people out there saying, hey, hey, Steve, how many burnt out owners do you want to have that are willing to sell for cheap? Because that's kind of the way that goes, is you don't have a lot of buyers. If an owner waits until they're burnt out and they're really kind of, ready to exit, and that can also be with retirement. If someone calls and says, hey, I'm retiring in 6 months, I just turned 65 and a half. I'm filling out my Medicare apps and whatnot. And, I'm going to retire in 6 months. Can you sell this thing? And they haven't trained up their team. Their financials maybe aren't where they want them to be. For a buyer, that's significant risk because, that owner's built it up. And so burnout's a bit of a, tricky situation. I would advise owners not to get to that point and then, decide that, hey, now that I'm burnt out, I'm going to sell, because that's a tough proposition.
Yeah. If they get to that point, they're burnt out for a reason, right? So likely all of those problems that are affecting them to cause the burnout are going to be reflected in the practice. And that's not probably good for the value of the practice at that point. So
exactly,
we've tried to have conversations with owners to say, I just have a motto: never sell when you're burnt out, because unless it's a something that you just can't help, but the practice is not in a good condition. Maybe work with a consultant, work on 4 or 5 key areas, try to get it into a position where, it's a little bit more attractive. And, we've had in some other industries, I've had some success with that, where somebody waited a year and a half and they got, an extra $1 million or $1.5 million because they did that. So theme here is never sell, make a decision when you are burnt out, because it tends to be a pretty bad decision that you make when you're in that kind of mental, state.
Yeah, that's a great point. And obviously we've worked with some mutual owners over the years, and and that's part of why we have a consulting team that works with owners. Sometimes it's just building value and helping them accelerate growth. Sometimes it's an owner that is a little burnt out and they need some fresh help with training that clinic director team, with kind of re-inspiring the team and getting things back on track. And yeah, that's a great point.
And it doesn't take much, does it? You're going to have to get in there and handle a couple of things, but generally speaking, some of the areas that are going to improve the value of the practice the most aren't necessarily things that are so overwhelming to fix that they take years and years and years. I think you can probably turn some of these things around pretty quickly. Yeah.
Absolutely. One of the first owners I worked with, when I started consulting, had a failed transaction. Ownership team was burnt out, and they sold a year later for significantly higher value. And we've done that with a few owners. It's not a huge investment. It's usually investment of time and energy in getting the team, back on track, leadership development, some small changes. It's really about the team being aligned, knowing their expectations, having the resources to achieve those. It's not big capital investments in most cases. It's really leadership training, engagement, alignment, core business concepts that hopefully, people have focused on throughout the life of their business. but sometimes those get off track or they run in cycles, and you just need some help, getting unstuck.
Yeah. And, to your point, I think at least most of the owners that we've ever dealt with, no one got into this business to like, oh gosh, I'm going to sell my practice for $15-20 million. I don't think anybody maybe they did. Some of them probably did, but, most of them were, practitioners at heart. And, I think the quicker that you can also try to think like an owner, entrepreneur, investor, and maybe not think so much like just a practitioner, that's going to have a tremendous impact on your planning, on how you build your business. And, cause you're a PT, right?
Yeah. PT that, had no intention of ending up, in the line of work that I do. Quickly went from treating PT into management, into minority partner. And we were in a very rapidly growing practice. I joined it in 2000. We had 3 clinics. Our goal was, build it, but we didn't really have a target of what that was going to be. And we built it to about 30 clinics, by 2015.
Wow.
Yeah. And, you mentioned this earlier, a lot of owners hit that stage where, every year they're challenging themselves to, do something they haven't done before, which is great. And that is typically inspiring and engaging. But sometimes, reaching out for help or getting help along the way just makes a lot of sense. And we did that in our practice. I think some of the best investments we made were, bringing in various people to help with the business. And one of the things we always did that I encourage owners to do is, always invest in building their value. And if you've got strong leadership, if you've got an engaged team, if you, invest in figuring out what works in marketing, what works in recruiting, that's going to build a more valuable business over time. And
was being an executive or an owner natural to you, or like, cause when you said you treated mostly, right? Like, when did you realize like, I got to have another set of skills of being a good executive or being a good owner? Was there something that just evolved over time as you did it?
I would say it evolved over time. We made a lot of mistakes along the way. I tell owners that all the time, be the first to admit it. I would say when we hit 5 or 6 clinics and we were in a rapid growth stage, we really started to realize that we weren't, we would kind of swing from not watching KPIs, key performance indicators on a consistent basis, or we'd, go do some training and then we'd be overwhelmed with data. And so we made a lot of mistakes along the way. I had 2 partners that were about my same age. The 3 of us were really running operations. We had 2 founders that are in their late 70s right now, so they were kind of stepping away. But we invested a lot, and we all did our MBAs. We all were in various leadership groups. This was before peer-to-peer, probably before you guys were doing your thing. 2003 or 4 maybe.
Yeah, sure.
And, and I would say a lot of the help we got was outside the industry and, strategic consulting, some decent things inside the industry with, with KPIs and benchmarks and, kind of understanding that we needed to have a better plan, classic work smarter, not harder, have a better plan. We started to bring in people that specialized in recruiting or marketing. And what I tell owners is, in any industry, there's some natural barriers, between 5 and 10 million of revenue, which in a PT practice, 1 clinic, you can do everything yourself. Whether you enjoy it or not, you can kind of keep your finger on everything. 2nd clinic, you've got to start to, bring up another leader, and you've got to let go of some things and be good with setting expectations, delegating, and being able to manage without, physically being there. Somewhere between 5 and 10 clinics is where you start to see owners benefit from that next layer of specialization, turning things into systems, because now you're opening, a new clinic or de novo every year. You might be doing an acquisition. And so you really need to start to, to shift to, more of that building value, strategic thinking, having a team, delegating, delegating results. And, and that's where I think amongst most owners we work with, somewhere in there is also that pivot from, I'm treating 80% and managing a little to, hey, I really need to step away from treating if I'm going to be really good at running this business and, supporting my staff, having the best staff I can so I can provide the best care I can.
Yeah.
And so, it was a steep learning curve, and we got a lot of help along the way, which is part of why we do what we do. It's kind of our way of paying it back, if you will.
Yeah, I love it. Let's talk about practice valuations and practice values. I equate it to like a credit score, because, you have a credit score, but it's made up of different factors. And some of those factors are more important than others. And I think when we start looking at practice valuations, it is a bit of an art and a science. Would you agree with that? I mean, there's some things that, okay, I mean, I can measure this, but there are some other things that, would affect the value of the business. Starting with like the most important thing, like if I'm looking at my practice value, being in someone that's in the industry, like let's maybe like go over 5 key things that would have the most importance of the value of the practice.
That's a great way to look at it. And I would say the first is really kind of going back to the results of it. And that's going to be the EBITDA, the size of the profit. Obviously that correlates to, you need revenue to generate, profit. But if you're looking at multiples, and you'll commonly hear people talk about, 3 to 5 times earnings, on up. The size of your profit, as your EBITDA goes up from 100K to $1 million or, 5 million, that's going to largely dictate, are you in that, 3 to 5X category? Are you in, 8 to 10X category or above?
Where's that stand right now in terms of, and I mean, obviously I know there's other variables too, but so if you said, if I'm in that 100 to 200 range, it's more of the 3 to 5, and then you get up.
I would say that's generally that's probably the ballpark, with a whole lot of, additional explanation, right? And obviously we'll get into those, but yeah, you'll hear that thrown around quite a bit. There's a lot of those other variables that are going to dictate that. The smaller the size, probably the wider the range that is. As you start to get up to, north of $1 million, 2 million, 3 million, you start to see that range narrow down a little bit. Those other factors are still important, but it's rare that you're going to build the, $2-3 million of EBITDA and not have strong growth, strong leadership. And so those factors still matter, but you just don't see someone, at least not very often, with a couple $1 million of EBITDA that doesn't have some other key pieces in place as well.
Right. So it's just the EBITDA kind of reflects other areas, because there's no way you could get that much of an EBITDA if you weren't doing some other things right, I think is what you're trying to say.
Exactly. Yeah. And, and if I were to call a buyer today and say, hey, I've got an owner, in this market, that's, whether they ask it or not, they might ask a lot of things about the practice, the leadership, the growth rate, the team. But really what the finance guys are looking at is, how much EBITDA is there and how much are we, buying with this one acquisition. And if we can do a larger acquisition, pick up more market share, more team members in one transaction, that's more attractive than doing 10 acquisitions to get to the same place. I generally start out with that is kind of the, number one driver of that multiple range. 2 and 3 are related. I would say, a very close, second is leadership. And obviously, that correlates, right? If you have strong leadership and someone who's building value, doing the right things, that's probably a growing, thriving practice.
And when you say leadership, like maybe expand upon that, like what does that look like in an ideal practice then?
Yeah. So ideal practice, if you're looking to optimize value, first it's going to be a leadership team that's proven and willing to stay on. Mm-hmm. When you get an owner that says, hey, I've built this and now I'm ready to exit, that's significant risk for a buyer, because if Eric has built this business and gotten it to where it's at, but looking to retire and go to the beach, right after the transaction, now I'm working with a leadership team that's, even if they're good people, it's an unproven team, and I'm not sure what I'm missing when Eric exits that practice. So growth oriented, people who are passionate about the industry, who aren't burnt out, who are running a good company, making long-term investments in recruiting, in retention, taking care of staff, and that's where you see a lot of the partnership models, USPH, Confluent, others that have always had more of a partner model of, we're going to invest in companies that have a team that's going to stick around, that's going to maintain equity, that's going to make sure things keep running smoothly into the future. It takes a lot of risk off, in comparison to, I'm going to buy this practice, the owner's going to step away. Now I've got to worry about, can the next generation run this thing as well, or are we going to lose people? Because, in this case, Eric was the glue that made it all happen.
Yes. So, okay, good. So point number 2 is develop a good leadership team that can, because obviously the buyer's going to look at that and say, okay, good. That reduces my risk if people are going to stay on and be able to run this thing without us being there. That's awesome.
And obviously a smart business as well. I mean, having a strong leadership team is going to grow your practice. It's going to, make it more profitable. But yeah, that truly matters. And when we get a call from an owner that says, I'm looking to retire in 6 months and I don't have a next in charge identified, it's really a game changer. That makes it harder to find any buyer, let alone, to keep the value, optimized.
Yeah.
Third, I would say would be growth. Past growth, best predictor of future growth. And if you look at, in your world, growth matters when you're picking stocks and the value of stocks, right? I mean, rarely does someone say, hey, go find me a flat investment that doesn't have a strong, growth potential. In our industry, people want to do acquisitions where, if they're paying, let's just say it's a 5 times EBITDA, that they've grown the EBITDA in 3-4 years, that they're looking back and saying, gosh, our effective multiple was half of that because we've doubled the size of the EBITDA. So growth rate will typically look at the last 5 years. Obviously, that means we're looking at 19 through 23 right now. We're early in 24. 20, most practices drop down a bit, but we're looking at new patients visits, revenue, have those all been growing over that 5-year period, with that expected dip in 2020 because of COVID. But, strong past performance, and a strong outlook for the future, whether that's, de novos, whether that's potential acquisitions, you really want that to be part of the story when you're going to market, is that, we're not a group that's plateaued and, we're selling at our peak. We're still looking at growth opportunities into the future.
What kind of percentage growth do you think would qualify you for, okay, so these bigger groups, that checks that box? Like what kind of growth are you looking at here? Yeah,
that's a great question. And we're in a little bit of uncharted territory in some senses, in that, the industry used to be growing, 3 to 5% annually. And so that was kind of a minimum. If you weren't hitting 3% annual growth, you're probably losing market share. And in some markets, you might be losing market share if you're not hitting 5% annual growth. Post-COVID, everyone is struggling with recruiting, and that's becoming more challenging. Retention is becoming more challenging. So, I would still say that 3 to 5% annual growth is a bit of a minimum. When you start to see double-digit growth, that starts to check that box that, hey, these guys are this team has been strong in the past, and finds ways to grow. Obviously, the larger the practice, the relative size might change. If you've got a $20 million dollar practice, 5% growth is significant. But in general, 5 to 10% growth is strong and attractive. Anything north of 10 is really attractive. And like I said, as you get larger, that might come down a little bit, but you want to be able to look at that and say, in 5 years, this practice is going to be, 20, 30, 40% larger than it is right now. And there's a path to get there. It doesn't have to be all mapped out. You might not even share those details initially, but there is a path forward for growth. And not just from a facility standpoint. The largest barrier to growing a practice is recruiting great staff. And so, a lot of times owners think in terms of facilities that I've got these 4 towns picked out, but if they don't have a pipeline, they're not doing a great job of recruiting. It's easy to go pick up leases and facilities and have, clinics that sit empty. Having a pipeline of students, having a pipeline of referrals, having a, successful history of recruiting, marketing as well, but definitely in recruiting, that's going to be attractive to a buyer, and that's going to show in the value of the practice.
Let me just kind of backtrack what you were talking about, Steve. So we were talking about valuations, and I think the big kind of pillars we're looking at, obviously EBITDA, leadership, growth, and then part of growth that would be reflected in that would be your ability to recruit people. So what have you seen out there, like from the best practice owners on how do I recruit better? Like, what are some things that you've seen from like really, really top-notch practices on how to recruit, how to do that a little bit better?
That's a great question. And I think 2 or 3 years ago, when we started to see that be a hurdle for most owners, we would work with owners that were spending a significant amount of money on marketing, and they'd have a 2-week, 3-week wait list. And we'd really, dig into that and say, hey, your barrier for growth is recruiting. It's not marketing. So let's shift some of that money and start to figure out where you're successful with recruiting in your market. Challenge there is, you're talking about small numbers. So trying to track trends and, where am I getting my staff from can be a little bit trickier. But in general, it's long-term strategies that are building relationships with schools, with students. Taking students is probably number one on that list. The percentage of students that turn into future employees or have the potential to, refer future employees to your company is significant. And so when we work with a practice that's not taking students or hasn't for a couple of years, a lot of times they're struggling with recruiting much more so than someone that has a robust, student program. Making it attractive, place to come work, whether that's mentoring, whether that's, good retention of staff, having incentive plans in place, things that resonate with staff. I would say referrals from staff is probably, number 2 in a well-run practice. Beyond that, it's finding what works in your market and with your clinic. There's some markets that don't have a lot of schools that tend to be more successful, being more active on the, recruiting advertising side. We've had owners who have worked with headhunters and found some really good headhunters. And, the call that I used to get a few years back was an owner saying, gosh, this headhunter wants $7-8 grand for a therapist. And they were looking for validation for me to say, yeah, that's crazy. You shouldn't pay that much. And usually, that conversation would, end in me saying, well, how much is that person going to generate in revenue? How much of that's going to be profit? And you're going to get that for $7 or $8 grand versus, you're going to be sitting here in 6 months still trying to hire somebody. And they would say, yeah, that's a pretty good investment, isn't it?
Yeah.
So I think looking at recruiting as an investment, and then not just throwing your money away, but, if you're spending, $5,000, $10,000 in some aspect, are you getting a return from that? Whether that's various advertising channels, I view marketing the same way. The more you figure out your systems, and I would say, going back to our conversation on what drives value, generating systems for growth, even though it's tied to growth, but I think that adds value to the company is you've got a system for recruiting, you've got a system for marketing. You know that if you invest 10 grand in something, you're going to get a predictable return. And that's not easy, but over time, that is smart to be able to do.
For sure. Absolutely.
And yeah, so, from there, it varies on, what else works in that market. Do they have relationships, or, frankly, do they have, competitors that are losing staff and finding a way to, be the, we always called it the employer of choice, the place where people want to work. When you have an opening, you've got, people that are looking to come to your team when you've got the capacity to bring them on.
Yeah. No, that's amazing, man. I think that was really good data for people to look. I mean, this thing is an investment at the end of the day. Your practice is an investment. It's not a job. And, if you really want to make sure that you're getting something of value, you have to treat it like an investment. And that means reinvesting back into it and not looking at every little thing that you're doing as, well, I'll never get that dollar back.
100%.
Some of these things are, will add value. You may not see it right away, but they will.
And that's a great point. And I think when you see larger outside organizations, private equity groups, investors, whomever it is, enter the industry and put a lot of money into recruiting, a lot of money into marketing, they're looking at their return on the value of the business, not just on the profit that year. Mm-hmm. So whether your value is 5 times EBITDA, 10 times EBITDA, something that might make you an extra $10,000 in profit is adding $50,000, $100,000 in value. And so that's really the difference between building value in a company versus building cash that you're going to take home and spend.
Yeah. Hey, if I'm an owner and I'm looking at selling, what are to get prepared? What can you expect? Because it really is something that is probably, it's so unknown to most people. You really only do it once. You don't get any takesy backsies. And this is the largest financial transaction of your life.
Right.
And there was a point in time where, and this is just because I saw, brokers or transition specialists in other industries. And I was like, God, what are they doing for their percentage? Right. I'm like, maybe some people just do it on their own. And I tell you, the transaction that you did with one of our mutual clients, when I saw all the things that you did and negotiated and had to go through, I was like, oh my God, you would be a fool to try to do this on your own. There's no way that an owner can navigate this whole sale of the practice by themselves. Making sure you have someone that knows what they're doing in going through this.
You hit a lot of the key items in that description. It is a significant portion of most owners, personal value, their family's assets. And so mistakes can be costly. Doing it for the first time, going it alone, can be a challenge. And that's a big part of why we do what we do. I got into PT because of service and enjoyment of helping others achieve their goals. No different in working as an M&A advisor. And so things, your original kind of lead into that was, what are things an owner can expect? Generally, we spend a lot of time preparing that owner, making sure they know what they're looking for. Is it a partnership? Is it a retirement? Is it, succession planning that includes, opportunities for their team. Usually it's a combination of factors. It's not just, one of those by themselves. So really, getting clarity, helping them get clarity around, what their goals are, what their priorities are in 5 or 6 key areas. Second piece I would say is really understanding the value of their business. And the mistake we'll see owners make is, they may go work with a generalist or their accountant on a value, and not to beat up their accountants, but
no, go ahead, beat up accountants.
Well, unless you're looking at practice sales on a daily, weekly, monthly basis, it really is hard to know what the comps are, what's happening in the industry, and really diving into it and saying, okay, how do we quantify that leadership? How do we quantify that growth rate? How do we understand, each market's different. Some markets are more attractive than others because of their, net rev per visit. Looking at their benchmarks, their labor percentage, their rent percentage. There's a lot of value in working with someone in the industry. And I'll give other groups, to owners and say, hey, talk to us, talk to these other groups. Mm-hmm. We all do intro calls for free. And we'll help that owner kind of get a sense of, what value is added by working with somebody that works in the industry, but understanding your value and knowing that, hey, this aligns, so I can go have my conversation with, my financial advisor, with Eric's team, to say, hey, we've got this much in retirement accounts, here's what we're expecting in the value of the practice. Obviously the accountant is a huge part of that. I'm not trying to throw them entirely under the bus on value, because looking at tax rates and understanding how is a transaction going to be taxed. That way an owner knows, hey, I'm going into this with fair expectations. And I typically am speaking in terms of probability of, we've got a high probability of being in this range on the final value. Once we know their goals, are there any groups that they're not interested in selling to because in that market, that'd be a tough pitch to their staff, whatever it might be. But really, preparing them so that when they go to market, they've got opportunities to talk to, what I would consider to be qualified buyers that are not just a cultural fit, meaning can you go have a cup of coffee or a beer or whatever you do and say, hey, I'd like those people. But is it also a good strategic fit in that the practice is going to be stronger going forward? It's going to be a better employer of choice. It's going to be a better provider of choice going forward, and not take a step backwards because of that partnership.
I love that.
So a lot of prep that goes into it. The deal itself, it's like any negotiation. When you add competition to it, and we just call it a competitive process. But when we're putting an owner, a practice out to multiple groups at the same time, you just end up with better offers, higher multiples, better deal terms. We see that all the time. That once we enter the picture and once we bring in multiple buyers, and the right buyers, you want to make sure that they're groups that are well financed, that align, where they're going to be able to look at this and say, hey, we can really do a lot with this practice. And so we spend a lot of time, really getting an owner in front of the right buyers. And so all of that really is what a good advisor should do. It should be an investment. They should be, paying for themselves and making your life easier. And, after their fees, you are taking home more money than if you were doing this transaction on your own.
No doubt about that.
And then there's the diligence prep. We have we're fortunate in that our team includes Robbie Leonard. Robbie's a PT who's also a certified healthcare compliance specialist. So by the time, we've gotten someone to a place that they're going out to market, there's just no surprises. Sometimes we'll see owners miscalculate their EBITDA, miscalculate an add back. They'll leave their salary out of the expense line. They might go to market at 2 months earlier than they should because of their past collections, or they go to market and they don't understand the AR or working capital, and in the letter of intent they'll sign it, and then they'll call someone like me and they'll say, hey, signed a deal, or we've got a deal in front of me, but is this a fair deal? And then you start to go down the list of, well, it's not just price. It's, it's what are they buying? Is it the AR? How is the working capital being calculated, which should be more standardized than it is, but we see significant variance in how buyers calculate working capital. So you need to clarify that. What are the terms of the deal? Is it, is there going to be a note? Is that note at risk, or is it just, a straightforward note? Are there any earnout provisions? What's your likelihood of hitting them if they are? What's the owner's compensation going to be, and what's their commitment going to be, to the practice afterwards? And then equity is a big part of these deals, as I'm sure you know. I mean, we've discussed this on past owners, really understanding, how is that equity being calculated? And a lot of past owners out there walking around, that have equity, but if you ask them, well, what's that based off of? What's the value of the company? Really don't understand, how that, equity was valued. And so those are all areas. It's not, usually we're helping owners negotiate better terms in all of those, not just in price, but we're making sure that, we're optimizing the terms, the working capital, that they understand, the equity calculation, they understand their responsibilities post-transaction. Yep. And you're right, it's a lot to do the first time, and stakes are pretty high. And, if we didn't help owners, get more value out of their deals, we frankly wouldn't do what we do.
There you go. Hey, to kind of end off, give me your biggest success story or win that you had with someone that sold.
We've.
I'm sure you have a favorite, don't you?
We have several that have been favorites. Some have been owners that haven't sold, that we've just been helping them build their value. We have a practice that, I'll give you a favorite, but an owner that brought on a minority partner that we helped them with an internal transaction where the minority partner owns 20% of the practice today, and that was to help build the value, build a stronger company. They actually haven't done a transaction to date, but their value has increased significantly because they have stronger alignment, they have a stronger team working on it. Everything from better dashboards to better strategic plan to budget. But that's what we help people with all the time. And on the exit side, probably the mutual one that you were referring to earlier. That was just a great case of helping some really good people achieve their goals, which in that case was, diversification of assets, moving on to, for one partner, moving on to some, personal goals, and, in being able to do that in a way that, took care of his family for a long, long time. And that's the rewarding part of it. And, like your practice, it's all about helping people and, helping people in areas that they have potential to, to fumble or to, not come out on top, that they will with a little bit of help.
Yeah, I love it. All right, man. Thanks so much. I got a million other questions, but we probably hit the time frame on this one, but we'll definitely have you back on and we'll talk some more things. But Steve, how can people get a hold of you?
Yeah, so 8150 Advisors. We always get the question, why 8150? That's the elevation of Vail, which is where our practice started. And so it's a little bit of a kind of link back to that. But 8150advisors.com. Our contact information is on there, and happy to talk to owners. We do a lot of intro calls just to see if we're a good fit, or happy to point them in another direction if we're not for any reason.
Excellent. Guys, definitely, if you're a PT thinking about selling, definitely give them a call. They do very good work, and you will not be disappointed. So thanks again, Steve. Appreciate it.
Thanks, Eric.